I think emerging markets still represent a very exciting opportunity for investors in global equity markets. First and foremost, they haven't been performing particularly well recently, so there is an opportunity to buy an underperforming asset class that still is growing rapidly and still has many exciting companies in its benchmark. And we think that, that 2020 could well be a year of recovery. And so unfavoured areas of the last 18 months or so could suddenly find favour again. And emerging markets always does very well when global growth picks up. So our liquidity analysis suggests 2020 is a better year, and emerging markets should do well as a function of that. Well, we put a lot of emphasis on country selection, so we're looking to manage the downside risk when emerging markets, specific emerging markets, go wrong, which they sometimes do for political reasons or for economic reasons. So we do a lot of work looking at the money supply in these economies, identifying which are going to be the strongest, which could be weak and vulnerable to speculative attack, and we make sure that we try and eliminate the worst performing markets, which gives us a good start against our benchmark. But then most importantly as well, we're also about buying good companies. So we buy companies that have a high or improving return on invested capital, that compound up their profitability, and typically we have really good quality growth stories in our portfolios. Well, the big story in EM is always about the consumer. It's about rising incomes. It's about income per capita increasing, and that then affording the opportunity for many people living in emerging markets to go and buy exciting new products or services. And so companies can increase their sales dramatically because we're talking about very, very large populations. So in our portfolios, we're typically overweight consumer areas. So in China, for example, we like athleisure, the equivalent companies of Nike. We have companies that are selling athletic clothing and sportswear. We also like education stocks, where obviously there's a lot of more money being spent on education and secondary and higher education in China, so there are lots of companies that are doing well out of that. And then in other parts of the world, like India, we like staples companies, where they can now afford a refrigerator, so they're going to be buying more drinks companies. So we like more staple areas in countries where development maybe isn't as far down the road as it is in China.